Hello. See, we already have some people joining. Awesome. Welcome and happy Wednesday. So as everyone is logging in, I want to just give you a few things that we could do to get to know each other. So we have a chat box. If you would like, I would love for you to drop in the chat box where you are joining us from today. I am right here in North Hollywood, California, enjoying the quarantine life. So let me know where you are at, and I will shout you out if I see it. Just drop in the chat box. I'm going to be the first one to do that. Hi. Hey, Kirk in Los Angeles. Hi, welcome back. Hello, Laura in San Francisco. Oh, wow. Hi, Mohammed from Dubai. Well, thank you for joining us today. Lovely, lovely, lovely. We'll get started in a minute or two. We'll go over a few things for today, but again, just keep dropping in the chat. Let me know where you are joining from today. Hi, Refi. Thanks for joining. Lots of San Francisco people. Hi, David. Jean from Brooklyn. I love Brooklyn. I used to live in Brooklyn. I lived there for 9 years. Love Brooklyn. So welcome. Thanks for joining us today. Yes, yes. I love Brooklyn has some of the coolest places to eat. I love Brooklyn. So it's almost noon. We're just going to give just 1 or 2 minutes in case people are going to join right at noon. Again, if you are on, drop in the chat box where you are joining from, and make sure to share with all panelists so that we all can get to know each other. Hey, TS from DC. Hello. I have a friend that's in DC right now. Hi. And then we have Marcy from Denver. Hello, Marcy. I love Denver. I've only been once, but it was absolutely amazing. I love Denver. Hi, Ed from San Mateo. Thanks for joining. And Kenmore, Washington, near Seattle. Hi, well, welcome. Thank you. Thank you. Hi, Rita, of course. No, this is super exciting for us to be able to do Meet the VC online, because now we get to be everywhere instead of just in one city. So this has been such a cool experience, and want to say thank you to everyone who has decided to trust us and go from live event to virtual with us. We're definitely trying out new things every week, but it's been really, really cool so far. Just watching people log in. If you just logged in, we're getting to know each other. So if you want to get familiar with our chat box, you can drop in the chat box where you are joining from. I am here in North Hollywood, California, enjoying this side of town. It's pretty quiet, of course, outside because everyone is chilling inside. Hi. And then there's Eric from San Francisco. Hi, Eric. Hi, Mark and Norca. Hi from Early Growth. Hello. Thanks for joining today. Awesome. Awesome, awesome, awesome. So we have a lot of people in here. So while we're doing that, you can still drop the city that you are joining from. But if you are a founder joining us, please let us know the name of your company and give us a 1-sentence pitch of what your company does. Hi, David. Hi from Tahunga. How are you? Hi, Tim from Pleasanton. Hello, everyone that's joining. If you're just joining us right now, we're going to start in just a second If you want to say the name of your company and a one-sentence pitch of what your company does, that would be awesome. We just want to know who is in our virtual room today. We'll get started in just a second. Hi, Harlan. CEO and founder of Now Us. It's an entertainment content portal. Awesome. Definitely need content right now. Well, everyone is at home. Thank you. Kirk from Epi Hour is a mobile tech company that delivers on-demand cocktails to you within an hour. I literally was looking for that last night, honestly. Honestly, I was. So thanks, Kirk, for joining. And then we have Marissa from Vim. We are wearables. Oops, I think that one too. We are wearables company focused on survival and safety, self-defense jewelry. Awesome. Thank you, Marissa, for joining. Awesome, awesome, awesome. Then we have Crew Tickets. Get Rewarded for Going Out is a live music event aggregator that lowers the cost of going out by helping users find the lowest ticket prices. Awesome. Awesome, awesome. Hi, Joy from Houston. On the Go Glam, a beauty on demand platform that delivers hair, makeup, and nails when and where you want them. Think Uber for beauty. Could definitely use that right now. So it's 12:04. I'm gonna go ahead and get started introducing our panelist. All right, just give me a second. Perfect. All right, so today is Wednesday, March 25th. We are meeting Eric Bahn today of Hustle Fund. So let me just tell you a little bit about me. My name is Teresa. I will be your host and moderator for today. I am also an entrepreneur and writer. You can find some of my writings in the Green Guide. And a fun fact about me is that I wrote a book in 2016. It was not the easiest thing, but I did get it done. So if you need anything to read, you can definitely find that book. So about today's webinar. So today will last about 40 to 60 minutes long. That includes our Q&A. You can ask your questions at any time using the Q&A panel. So just drop your questions in that Q&A panel. If you happen to drop it in the chat box, don't worry. I'll try to grab it from there. Feel free to continue to talk to each other, to connect with each other. This is being recorded and it will be available on YouTube, and we will send a copy of this presentation via email. So let me tell you a little bit about Early Growth. If you are not familiar with us, we are your strategic partners. So we are a team of experts that allow founders to concentrate on their business, their customers, and their team while we lead their finances. So what do? We do finance and accounting, taxes, just like right now, if you still haven't done your taxes, we can definitely help you with that. Equity management, and we also do fund accounting for many, many investors. This is not our first rodeo. We have been in business for 11 years. We've helped raise $2.5 billion, and we've worked with some really cool companies, some that you may notice, like HelloSign, Credit Karma, Hum, and Stitch Fix. And currently right now we have a tax promotion going on. So again, if you haven't filled out your taxes and you are a C Corp, we can help you with that. We'll take $500 off of that C Corp tax preparation. You just have to sign up by April 1st. And to be able to do that, just go to earlygrowth.com/tax promo. And I will put this up at the end of the presentation, so don't worry. I also want to take some time to thank our partners for today. So first off, I want to thank TriNet. Thank you so much. You've always been such a great longstanding partner of ours. TriNet provides businesses with HR solutions, including payroll, benefits, risk management, and compliance all in one. We also have Latham and Watkins, who is one of our partners. Thank you for partnering with us today. Latham and Watkins provide strategic business and legal advice to private and public technology, life sciences, and other growth companies every step of the way, as well as the venture capital firms and investment banks that support them. So if you're looking for some legal guidance, advice, please reach out to Latham and Watkins. And we also want to give a huge, huge thank you to one of our longstanding partners, Pacific Western Bank. Thank you so much for partnering with us for today. And then the moment we've all been waiting for, our special guest for today. Let's welcome Eric Bahn. He is a VC at Hustle Fund. Their focus is general, but they do invest in B2B, fintech, marketplaces, digital health, and more. He was previously a product manager for Facebook, and a fun fact, which I would love to talk about, is he took a year sabbatical. I am a little jealous of that, but welcome, Eric. You can unmute yourself.
Hi, Teresa. Thanks so much for having me today. And thanks to all the guests for making it out as well.
Yeah, so cool that we get to do this. Thank you again for being here. So let's dive in. So I want to get to know more about you. So where did you grow up and what did you want to be when you were a child?
So I grew up just outside of Detroit in a suburb called Bloomfield Hills. So I was there for the first 18 years of my life. And I think I was pretty confused about what I wanted to become. I think doctor was my default answer just because my dad was a doctor. But another fun fact, I remember actually taking a career quiz sometime in elementary school. And then the top 2 recommended professions that they suggested was number 1, mortician. Wow. And then number 2, parking lot attendant. I forgot number 3 and 4, but probably venture capitalist was either 3 or 4 at that point, right? So okay. Relevant skills.
Oh, wow. That's pretty interesting. So you were a product manager for 15 years, including your time at Facebook. So why did you want to become a VC? And then how did you make that transition?
Yeah, so just to clarify, I actually spent most of my career as an entrepreneur. I started and launched media businesses. The first was a media company in the education space. Ran that for 9 years, sold that to the Daily Mail in 2012. And then I started another media business after that. And then Facebook was about 2 years as a product manager. Wow. So, as a founder, I spent most of my career to date actually on the other side of this Zoom call. The founders who are the attendees here today. And in general, it was a pretty horrible experience working with venture capitalists. It felt like the incentives were misaligned. I didn't like the way that I was treated. I felt like an asymmetry of power where I was essentially just begging for cash most of the times. And when I had the opportunity to start this fund alongside my co-founder, Elizabeth Yin, who's also a very talented founder herself and seasoned VC, we want to change the social contract for how we work with founders, where we can cut some of the the bad behavior that has become sort of tropes in the VC industry and on Twitter, and create a different kind of model for how we collaborate. And I'm happy to explain that a little bit further as well, but hoping to fix the problems that I saw from the inside.
Yeah, no, definitely I would love for you to explain that just a little bit more.
So at Hustle Fund, we focus on early stage investments focused on the pre-seed stage. So pre-seed is a really strange time to raise money. Usually it features angels and family members, a lot less so VC funds. And the number one quality that we have in our thesis we have just a single quality that we really, really try to emphasize and trying to discover in founders that we invest in. And that quality is described as hustle. So for us, hustle is defined as great execution meets high velocity. And the area that the opportunity that we saw where we could make a pretty large impact and frankly arbitrage was the fact that we don't think that most early stage VCs actually focus on hustle as like the key attribute for unlocking really great founders. Mm-hmm. So I'll sort of tell you like the typical way that a VC fund would make an investment. It's me and Jerisa as the general partners. We talk to a talented founder. And it's essentially like an interview loop, right?
Mhm.
We're talking, we hear your pitch, maybe we invite you back to pitch further. We ask for a little bit of data. It probably doesn't exist because you're a seed stage fund or seed stage company. And then from that basis, Jerese and I make a decision to give you $500,000 and we pray that it works out. Here's the problem with that model is that when you're trying to make a basis of your decision on how much to invest or such a large sum to invest based on things like interviews and pitches and so forth, it's very easy to fall back on implicit bias. So what I mean by that is today, if you're to be pitching in Silicon Valley, those who tend to do the best fit a very narrow profile. It's white or Asian men. Oftentimes they're wearing a hoodie. They went to Stanford or MIT, have a computer science degree, worked at a Google or Facebook, right? That's what feels safe, quote unquote, right now. And what we discovered from our research and from our own history of investing is that, just because we have those qualities is not necessarily a negative thing, but it's not necessarily either a great predictor of success that people who fit that profile will consistently outperform, build great businesses, et cetera. Instead, we have a different first principle at Hustle Fund, which is that great hustlers look like anyone and can come from anywhere. And we've actually discovered from our own investing, we've done 132 investments to date out of funds 1 and 2, as well as our own angel investments before that, as well as the other funds that we worked at before, that founders look like everyone. They truly do look like everyone. Sometimes it's folks who are very pedigreed that do well. Sometimes they fail. Sometimes it's people who barely graduated from high school who enormously succeed, and sometimes they don't. Women, African Americans, underrepresented minorities can crush it as well. So instead of trying to make a decision based on pedigree, we want to focus on how well you execute. So here's the problem, okay, is that I can't determine who is a hustler just by talking to the founders in the same ways that other VCs do, because the problem is I'm frankly overladen with racism and sexism myself. So I grew up in a very privileged part of Michigan. I went to a very privileged school and I worked at rich kids places like Facebook. There's a really, really narrow grouping of people that I were mostly exposed to throughout my career. And that no doubt seeps into my own judgment of people at first. So instead, in order to counteract our own implicit biases as GPs, general partners at the fund, we have a different model for how we invest. We first start with a very quick $25,000 check that we write into a lot of teams. And we make sure that we are highly inclusive in terms of the companies that we're investing in at that early checks level. Usually we can make that decision within 25 minutes of meeting the founder. And if I feel like there's something kind of interesting that the team is working on, or any of our GPs do, we'll then proceed with working with the team on a growth project for 4 to 6 weeks. Usually this is related to sales or user acquisition, sometimes fundraising. But by collaborating alongside the team, that's when actually the true due diligence is happening, where we can get a sense of the team's execution, listen to how they're selling their products, how they're recruiting new people, seeing how the co-founders interact with each other, and generally get a better sense of the market too. So real hustle and real understanding the market tends to happen once you work with the teams. But what's also happening is an even more important activity on the other side. The founders are also judging us during these growth projects to see whether we're a venture capital fund that's truly adding value. So if your assessment after our 4 to 6 weeks together is that Eric is super lazy or an idiot or something like that, then we don't deserve to be a part of your journey moving forward, right? But if you find that the hustle is great on both sides, we are actually adding value to you as well, then we've hopefully formed the basis of a really good relationship that can last a long time. And what we find is that in about 20% of cases, actually, once we've written that first check and then run the growth project, we find that we really like the hustle on both sides. We like operating together. We respect each other's execution. And also we think that the market's really interesting that can support a venture backable outcome. In those cases, we'll then concentrate a much larger check in your next financing round between $250,000 and $1 million to make those companies a core position with our fund. So essentially small check, growth project, which is our true due diligence on both sides, and then big check into teams that hustle well into great markets. And today, like what we find is in improving the grand thesis and principle that great hustlers look like anyone come from anywhere is that at the very end, the portfolio that becomes a concentrated position is actually naturally diverse. So it's about 50% women, 27% underrepresented minorities, 70% outside of Silicon Valley. Essentially just looks like the population of the United States. And I guess that shouldn't be too surprising, but for whatever reason, that's pretty controversial to have a portfolio that looks like that. And ultimately, I think the last thing I'll add, and I know this is a little bit long, Teresa, but is that there's a longer term mission that I think our fund is trying to prove, which is this notion of inclusivity as being the advantage for how you make the most money. So today I hear about a lot of diversity funds, or like, some sort of fund that has some sort of diversity initiative. And implicit in what I hear in that is a lowering of the bar. Like, that's just what I'm hearing. It's just like, yeah, we have this thing for women, or we have this thing for diversity. And when you ask these managers, like, well, how are you measuring success then? It's usually not related to capital outcome. It's not, it's something else. Just like, we're checking a box here, making ourselves feel good. I really reject that notion that, diversity is something you just do to make yourself feel good. Instead, if you actually buy the concept that by being more inclusive and open to diversity at the very top of your funnel, being able to support those founders, you then actually now have a much broader set of great, talented founders that you can begin to work with. And some of those founders will go on to build great businesses, and they're often going to look like people that you don't think fit the normal trope of Silicon Valley. And by being more inclusive, that's actually how you make the most money. And if we can prove that in our fund, that, inclusivity is actually the path to making the most money as a venture capitalist, then that will compel, I think, our peers to also be more inclusive in their own funnels, and hopefully change some of the narrative and tropes in Silicon Valley as well.
Wow, that is so great, Eric. I wish we could clone you a million times, and I wish more people really thought about diversity and funding like that. I'm going to take one moment. I want to actually see, I just launched a poll for everyone. I just want to see, where people are in their fundraising. If you guys could just fill that out for me. I'll give it a second before I end it, just so we can know, like, who's bootstrapping, who's already raised. Just take a second to fill that out. Yay. I need background music. I had to get background music for this. Also, I'm gonna wait a little bit. We're got about 51 people. So I'm gonna give it just a few more seconds so we can get a accurate representation. All right, awesome. So I'm going to share those results. Awesome. All right. So it seems that we got 40%. That's bootstrapping. 25 are friends and family. Okay. And some people that have already raised. Awesome. Cool. And so how long does it take you to make that decision whether you're going to invest or not?
Well, for that first check, it's pretty quick. So if I were to give like a really rough rule of thumb, when it comes to that $25,000 check, it's really about being 60% convinced that there's something kind of interesting happening here. And the goal is actually to take a lot of risk on that first check, because we want to actually do the real due diligence, which actually happens when you collaborate with the team. So the collaboration is really the true due diligence on our part. And again, it sort of works both ways. At that point, when we have finished the growth project, we want to have like 95% conviction that, we think that this is the right kind of team that knows how to execute against the problem that they're trying to solve in their market. Sometimes that decision can happen as soon as 4 to 6 weeks after that first 25K check. We've also waited as long as a year. A lot of that is also directed by the founders, because sometimes they actually don't need financing by the time that we're ready to offer something. But the goal here is also just, I do want to reiterate one thing here, which is, when you're doing early stage VC, you're actually signing up for a very, very long relationship with the founders. Our funds last 10 years, and generally I think it takes about 7 to 10 years for a company at the early stages to reach their maturity to IPO or get acquired by Google or whatever the outcome is going to be. And so, a question that I find myself asking for me, but also what I challenge founders to ask too is actually the same question that I asked my wife when I asked her to marry me, which was, do you want to grow old with me?
Oh, love
Right.
it.
And laden in that is actually a couple of things. So first of all, it's cheesy as hell. I'll call that out, not myself. But the second is like, it's a pertinent question because not only there needs to be really good complementarity of skill set and professional relationship, but I think you need to like the other person as well, because so in my experiences, like when I did fundraising, I had very few investors. Like I primarily bootstrapped myself, but I did have an investor that I'm thinking of right now who was mildly annoying on year one when I accepted his money. It was a tiny amount of money. And then by year 6, he was utterly insufferable, right? And there's nothing worse than having crappy advisors or investors on your cap table, because the journey that you're going down in launching your own company is already stressful. It's like existentially stressful at moments. Adding the overhead of a bad investor is like unnecessary pain that you're putting upon yourself. However, the system of venture capital is not designed to make founders feel like they have really good, thorough grasp as to whether their VC is a good partner or not. These are marriages of convenience largely, right? So if someone's offering you a term sheet and saying you have 24 hours to decide, sometimes the right decision is to take that money, even though there are massive consequences against that. In our model, we hope that we are held accountable in proving our own value first, to make it a very simple decision that you do choose to work with us later on if there's a good fit on both sides.
Thank you for that. So we have to talk about, it's not the elephant in the room, but it's outside, COVID-19 and how that's affecting startups and businesses. Do you think you're going to be slowing down investing in companies in the next few months?
Yeah, that's a great question. So yes. So the answer is absolutely. I mean, we'll still be making investments, I think, between now and the foreseeable future. We just launched our fund 2. And the reality too is that great founders need to launch their companies whenever, regardless of conditions, when the timing is right for them and their perceived market. So of course we want to align around that. But there's a couple things that are happening that we need to really understand. First is actually stress testing to see what the downstream fundraising market is going to look like. And right now we're a bit confused as seed investors. If fundraising is not available now as an option for the Series A and beyond, then I would really caution founders actually from going down the path of raising venture capital now at the seed stages, even if you get it, because that sometimes can create the cycle where you will be not necessarily required, but it kind of feels like that to raise another capital raise like in 9 months or 12 months or 18 months down the line. So part of it is actually getting a little bit of grasp around that. But the second, and this is actually, we're going to call out some asshole VC behavior on my end, is that we're kind of watching valuations plummet right now too. And I want to see where that settles. So, I mean, the reality is that 2 months ago, when the economy was looking in better shape, valuations were rising for the last couple of years. But now I think that we're in that black swan moment that Sequoia has described, where valuations are going to drop pretty substantially. I looked actually at some data from the last recession just this week, and I saw that valuations were bottoming out about 1 year after the recession started. So yeah, around like late Q3 2008, I want to say, is when the height of valuations were, right leading up to recession, and then about Q3 of the following year is when it bottomed out. So for us, like, we're going to be writing checks, and we actually still have, in fact, I did a deal yesterday, but we'll be fairly cautious, and I think that activity will pick up pretty swiftly again on our part towards the second half of this year. But I want to sort of I don't want to, I guess, BS this either. I mean, like, valuation is actually one of the most critical levers that VCs have when it comes to our side of the business. So I'll sort of explain a little bit more about why it makes sense. If you're a small fund like ours, and a small fund is really broadly defined in VC, anything under $100 million is a small fund. We're roughly about $30 million for our fund too. The way that we make money and can continue to do our jobs is actually by making sure that not only do we select well into founders for VC investment, but additionally to that, that we actually select well and get the right kind of multiple on return. And the best lever for multiples in return is actually valuation. So here's an example. Let's say that Teresa is running a fintech company, and she goes out and raises at a $10 million valuation. And she gets that money together and we participate. For us in our fund, the definition of success is getting 100x on our post-money valuation. So 100x of 10 million is a $1 billion outcome. Let's say that the world collapses and then the same founder, Teresa, comes out and asks for a $2 million valuation. Okay, and we decide to invest then too. This is an extreme case. Or let's say 1 million to keep the math simple. So 100x 1 million is $100 million. My belief is that there's almost 10 times more acquirers that are ready to buy a company at $100 million than they are $1 billion. And when you can come in at a lower valuation as a venture capitalist, then it's actually greater and greater risk-adjusted certainty, nothing is certain in this business, that you can hit the multiple that you need to return the fund, that is to return the original principal back to your investors, and then get into a profit-sharing mode for everyone. And once you get into that profit-sharing mode, which is called carry, that's when you're really unblocked and allowing yourself to raise future funds to continue this work. So I think, one of the jobs I have as a venture capitalist when I work with my portfolio is always calling out very specifically where there's conflict of interest. So like on the founder end, like, of course you want to raise at the highest valuation and be as non-dilutive as possible. That is like sell as little of your company as possible to unblock your work. And that's always something that you should fight for. VCs always want to fight for the opposite, which is actually not always, there's some nuance here, but like in general, they want to get lower valuation because it's actually one of the best ways that they can make the mathematics behind their fund model work so that they can continue to do this work. So not sure if you're ready for that kind of blunt answer, but that's ones I have.
No, we definitely need, we need those answers because I think a lot of founders are trying to figure out what should be their next step, which is a question I have for you. Also for all of our attendees, I mentioned this earlier, but feel free to drop your question in the Q&A box and we will get to it at the end. But for you, Eric, what advice do you have for startups? What should be their next step, especially if they were planning to do another round of fundraising this year?
It's going to be really tough. So I guess I'll share a couple things around the macros that I'm seeing. And then we'll sort of talk about maybe the tactics for unblocking ourselves this year related to fundraise. So it may come to a surprise to some of you if you just woke up from a long sleep that we're entering a recession right now that's triggered by coronavirus. And a couple things that are happening that are to the capital markets. So one is like if you're holding some stocks in your portfolio, not everyone is, but some are, you might have noticed that we're down like 40% on the public equities market. And venture capital is a very interesting kind of asset class because it's usually considered to be an uncorrelated asset, which means that ups and downs on the public equity side, like your Facebook stock or Google stock that you own, should not be correlated to the ups and downs in private equity in venture capital. Like these are private business assets that we're buying. But I think the truth is that they are very closely correlated. So example would be like, if angel investor Jerisa has like a $10 million net worth and then she's angel investing, but then she wakes up 3 weeks later and sees that her net worth went down to $6 million. That's actually a very emotionally hard hit to see like $4 million evaporate over the course of just a couple of weeks. So like, is she going to be in the mindset to take a lot of risk? Perhaps she will, but in many cases, I think she's going to wait and see. And in Silicon Valley, at least, but also increasingly across the United States and the globe, angel investors are one of the first frontline forces when it comes to underwriting early company investments, right? Like think of like your friend who's like a technology CEO who's done pretty well, maybe sold a company, and she has a little bit of money to invest, and you want to go to her first. That makes a lot of sense. And in frothy times, that's one of the first easy checks to get. But in these times, that money might have evaporated, or the risk tolerance might be pretty low. In the case of microfunds like myself, those that have less than $100 million in assets under management, we actually also rely on angels and high net worth individuals and family offices, which are basically high net worth individuals, to fund our funds. So we're seeing a pullback right now on those capital sources that we also share with you as angel investors, or sorry, as founders, who are no longer funding small VCs. So I think there's going to be actually a contraction in the number of VC funds that are going to be available even by next year. In the last Great Recession, I think there's like something like almost like a 50% drop in VC funds that actually they just folded and went out of business or just slowly went away. So it's those create ripple effects to you, the founder who's seeking financing, right? So your angel sources are going to go away. Your some of the VC sources too, who focus on early stage, are also going to start to go away. Therefore, capital sources are going away. There's less competition for other funding sources that are really well funded, like Sequoia and so forth, and that's going to affect their valuation. And it's also going to lengthen the amount of time. I think from the Great Recession, leading up to it, I saw data on this just yesterday. It took about like 1.7 years between financing rounds from like the seed to Series A, and that increased to about 2.1 years, I believe, after the recession for some period of time. So longer fundraising period, and then less capital sources. So what do I do, right, if I'm a founder with all this dire news? Well, I think it comes down to first understanding and believing this one principle. Like, I still believe that founders need to start their companies whenever the opportunity is right for them. And sometimes the opportunity happens during the middle of a recession, right? So there's some businesses that are proving to become anti-fragile during this period of times. I'm not going to go into this too much, but like there's this amazing, amazing essay by Alex Danko called Anti-Fragility that was released on March 12th. And in it, he sort of talks about how there's certain classes of businesses that in periods of extreme economic shock like this actually perform way better. So think about like how Zoom video is doing. Like I think at large, like they're up quite a bit. Like now that remote work is something it's happening now. Instacart is also a very interesting example. I've heard actually rumors that business was actually doing quite poorly. Like, you know, fine, but not like great, leading up to coronavirus. Now it is an essential service that is feeding an enormous part of the US economy, right? And I think it's actually going to be mental muscle memory for quite some time after coronavirus leaves too. Right. So you might be operating in one of these anti-fragile kind of sectors too, where, you know, even these kinds of shocks could improve your business. So think about that, especially if you're in the early stages of idea formation about your business. The second thing too is just like, you know, it's still possible to fundraise. And the way that I would do it is by just focusing on collecting your checks through safes. So Y Combinator has a very simple document called the YC Safe. You can download it just from their website. Just Google YC Safe. And, you know, as you have conversations and do fundraising, I would actually just collect whatever angel money is available, because there is going to be some people who are still deploying checks, and then do what's called like a tranching method. So this is actually sort of a controversial tip. Like venture capitalists actually hate this. Basically, like go out, like let's say you want to raise like $500,000. Maybe you split it into 2 tranches. In the first $250,000, you set the valuation pretty low. Let's say it's like $2 million or $3 million post-money valuation. Collect the checks from investors that you think would be kind of strategic. Like let's say Jerisa is like the queen of like fintech banking relationships or something, and you're in a fintech business. Like you may want to just capture her at whatever valuation just because she's gonna be so strategic and can help you build momentum. Once you fill that first tranche of $250,000, then go out and open a second tranche of $250,000 at a higher valuation. And if you need more capital, then do another tranche at a higher valuation, until you're essentially just dollar cost averaging yourself into like some sort of valuation that the market can support. It's going to elongate your fundraising process, but it's a good way of kickstart a fundraise process by going purposely a little bit below what you think the market rate would be for a business to capture some momentum, and then build from there. And you know, most VCs are momentum investors. Like when they see that you put together $250,000 in relatively good time, they're going to be inspired by that and feel a little bit FOMO'd. And it is still possible to FOMO investors even during these trying times. And then the last thing is this, just like, I talk a lot, so prepare yourself for that. If you can bootstrap. I mean, like, VC is such a horrible path in many cases. It's like a cocaine addiction. I mean, like, once you start actually accepting that money, there's gonna be pressure and expectation from your VC to keep raising money in the future in relatively short order because they want to see valuation markups on their own portfolio. So here's like a really stark conflict of interest example of this, of where the VC's interests are now aligned to yours. It's like, if I invest in Jerisa's business, let's say at a $5 million valuation, it'd be really great if, like, 9 months later, she raised another seed round at a $10 million valuation. So then I can go to my own LPs and say, like, LPs being limited partners, my investors, and say, take a look at me. I selected such a great founder and and her company's already doubled in value in 9 months, right? And we can actually call those marks every time she raises subsequent money at higher valuations. And even though it's paper money and paper gains, it's not real money. That's usually enough to go out and raise another fund in the future, right? So for VCs, like, being able to raise funds is such a strong lifeblood to allow us to do this work. And this creates actually at times really strong conflict with founders on, being forced, not forced, but like really strongly encouraged to raise money. So if you want like to be free from that kind of pressure, bootstrapping is really the way to go. Obviously there's downsides because you have to operate with a lot less capital. But it gives you utter freedom in terms of how fast or slow you want to grow your business, because quite frankly, there are fast and slow times in any business. The last tip here too is, like, if you have been bootstrapping for some time, you have some traction that's meaningful, you may want to look at revenue-based financing, which is a form of merchant cash advance or debt. And there's services like Clearbank. Hustle Fund actually has a service called Flywheel Financing as well. That allow you to take capital that's non-dilutive. So the idea behind that is, like, I invest in Jerisa's business. She's pumping cash. I give her $100,000, and then it's basically a revenue share on her profits for some period of time, where, like, she pays back the $100,000 plus some sort of agreed upon interest, like 8%. But it's not a loan. It's actually a share of profit. So it tends to be a lot more flexible in terms of the payback period. And it's not personally guaranteed. So you don't have to put up your house. Like, if your business falls and goes out of money and you lose money, like, that's just on the RBF fund that they lose money and nothing happens to you. A lot of loans actually require personal guarantees, which are scary as hell, right? It's just like, yeah, I got $2 million from this bank, but they might take my house if the business fails. I don't think I even have the intestinal fortitude to do something like that.
Yeah. Thank you so much for that great explanation. I'm going to ask one more question, and then I'm going to take some questions from the Q&A. If anyone does drop a question in the chat, just make sure you share with all attendees, panelists and attendees, or drop your question in the Q&A panel. For those founders who are looking to get into programs like 500 Startups or Y Combinator, I know you are a venture partner for 500 Startups. What advice can you give founders who are seeking to get into those programs, especially since they do provide some funding?
Yeah, so it's a little bit different. Each accelerator has sort of different kinds of themes, but I think the one thing I want you to understand is being very eyes wide open on what the terms are. Generally, you get some money between $100,000 and $150,000, but you're also selling usually about 7% of equity into that business, of your business into the accelerator that's funding you.
Yeah. So
that is pretty expensive. And it can go up to like 15% too in some cases. So you got to be like crystal clear that it's worth it to go through these programs to give up that amount of equity. And I'm actually convinced that it's not worth it in most cases. Now, if you believe that like having the brand is going to be helpful, or like the network that like Y Combinator provides is going to be helpful, like there's really good reasons to actually believe that. And you still want to pursue it, then I think a couple things are going to be important. The first is actually making sure that you cover the basis that is required for not just like presenting yourself well for the accelerators, but really what every seed investor is looking for. There's really 5 criteria that you really need to have crisp answers on, which is team, problem, solution, market, and traction. So team being, I'll go through each one. So team is, does my team have the relevant skills and backgrounds to actually solve the problem that we're going after in the given market? So a weird team matchup would be like me and Jerisa are marketers at Procter and Gamble selling shampoo, but we're going to start an autonomous vehicle company, right? Like that to me is like such a mismatch because we're not like, engineers probably or anything like that. But if it's like a, designer shampoo, D2C kind of business, maybe that's much more relevant. Team also has a little bit more nuance to, like, ideally your team, your co-founding team or your early employee team, like you guys have built something before together too. Like there's some evidence that you know how to work together, because co-founder breakup is a major reason that companies fail at their early stages. They just start hating each other, even if the business is great. So that's team. Problem is there a very crisp problem statement that you can share on exactly what you want to solve? And how did you arrive to that problem? So it's not enough to just say like, we need Uber for families. Like, I largely agree with that. I have 2 young kids and I hate hauling around car seats and all that. And it'd be nice if that existed, but I'd love to hear more specifics on how you arrived at that problem. Like, how many customer interviews did you do with parents or with drivers? Like, why hasn't Uber done this before yet? Like, just having some of the basics in terms of how you arrived to that problem statement is really critical. The solution is generally the product or service that you are building to solve that problem. If you have any early prototypes or demos, that's always helpful. Market, this is one that I think is really poorly done in most cases. It's describing not just how large the addressable market is, hopefully it's measured in the billions of dollars to be venture backable. But in addition is like your go-to-market strategy. Like, what specific acquisition channels do you want to use to get your users? Is there any early tests that you have to show what cost per acquisition is and so forth? Go-to-market and like mapping the size of the total addressable market, I think, is critical. And finally is traction. So for me and most seed investors, traction is usually the most optional. If you're super early, you're not going to have much traction. Even if you do have traction, it's not going to be like product market fit traction. But if there's like an early pilot, like, oh yeah, I'm working with Google as like my first client, or if it's like a consumer product and you're like, yeah, I got like tens of thousands of users playing my game. That's something, because it shows that like this is that you have what it takes to actually do a little bit of go-to-market execution well, and are taking it seriously. So team, problem, solution, market, and traction. I think that's ultimately the litmus test that you need to review to make sure that you covered all those bases after you've completed your application. And if you're missing 1 or 2 of those big criteria, then you may want to go back and re-edit and make sure that you're representing those well.
Thanks for that. So it's Q&A time. And I see this question from the chat, so I'm going to start with this. This is from Noman. Hi, Noman. He says, how to reach out to you and apply to Hustle Fund. So how can he touch base with you?
I appreciate that, Noman. So the easiest way is right through our front door on our website. We have, if you go to hustlefund.vc, that's hustlefund.victorcharlie, VC. Every single founder that we speak to, whether it's from a warm introduction or a cold introduction, is asked to go through our website form. There's a button there that says, what are you hustling? You can click on that, and it's a pretty short, I think like 5-minute type form where you can provide some information about your company. So we review all the submissions on a daily basis there, and it helps us to start to do our triaging in terms of those that are high priority, lower priority, and so forth. One thing I'll make clear is that right now we only support 3 geographies: the United States, Canada, and Southeast Asia, which is really broad. Southeast Asia is mostly Vietnam, Singapore, Indonesia as our primary markets. We don't support other geographies just yet. I hope that we can do that in a future fund. So that's actually the top reason why we disqualify companies, is just like, they're building an amazing company in Africa or something like that. And we'd love to support them, but we just don't have the mechanism to do so yet. So that's going to be the easiest. And we love cold introductions. In fact, this is like, I could talk about this all day long, but I actually think that one of the dumbest dumbest biases that venture capitalists most VCs have is actually that you need to have a warm introduction. That's ridiculous. Like, I mean, I'm very empathetic to founders who have no network, but extreme talent who can't get a warm introduction. So if no one else wants to talk to you, I'd love to talk to you.
Love it. So this question comes from Derek. He says, if VCs closed funds between 2016 and 2018, wouldn't their commitment periods force them to invest sometime this year?
That's a really awesome question. So this actually shows me that you have a pretty good understanding of how VC works. So let me sort of break it down to you what a traditional VC fund looks like, just speaking my truth, because I think ours is relatively traditional. Is a VC fund lasts 10 years, meaning I accept Therese's money and then I'm expected to invest it and then produce some sort of return back to her within 10 years. Okay, sometimes there's extensions like 11, 12, 13. But generally, like, it's a long-term asset, but one where there's expectation where the money is going to come back in a big way, hopefully within 10 years. There's also an active investment period, which is generally about 3 years. So the very first 3 years is when you're deploying the checks, and then hopefully you deploy your money. And then from years like 3 or 4 to 10 is when like the returns start to come back. So this kind of makes sense when you think about it. Like if you're doing early stage investing, and I mentioned it takes like 7 to 10 years for a company to mature, it's not like I can give Therese money now, and then next year she's going to IPO for like $1 billion. I guess it's happened before, but like it really is not something that could really realistically happen. And in my career, I'm not expecting those kinds of cases. So like, you know, building in some period of time where you deploy the money fast and then wait makes sense. So I think there's something to this argument, which is just like, if you're looking at the vintage of when the VC raised money, so vintage is almost like vintage of wine. Like, oh, this is a lovely Chardonnay from 2013. You know, like, it's like, you know, if money was raised and closed in 2016 or 2017 or 2018, I think you're right, which is like VCs will have some pressure to make sure that they're deploying it during their active investment period. That said, active investment periods are not set in stone. So let's say that, like, you know, a general partner like myself is making the case, and I'm actually not nearly this negative, but let's say that I'm like, the world is ending, right? Like, just like the 4 horsemen are appearing in, like you can sort of make the case of like, we're going to just stop investing for a year or two and then come back to this. So we're modifying and amending our limited partner agreement to add 2 more years. Like, I've heard of things like that happening, and those who are really alarmist might actually be going down that path. And LPs, frankly, are pretty accommodating. So like if they're taking guidance and like, the world is collapsing, you know, here's all the evidence, then I think they'd be amenable to changing. And also just frankly too, like, let's talk about like the super awkward comment I made earlier, this webinar is just like, there is some value for VCs to wait for valuations to drop too. So even if you're like kind of extending past the active investment period of your fund, but you can make a case that valuations will bottom out in the next 8 to 12 months, then you can sort of make the case of like, look, we're going to keep investing a little bit past the period because we think some of the best deals are about to come, right? That's the most, like, again, like super capital driven perspective, super cold hearted VC perspective, but I think it's really valid and one that you should keep in mind as a founder too.
Thanks for that question. This question comes from Greg. Hi, Greg. I'm curious, how does your answer on valuation change with respect to unpriced rounds like safes and convertible notes?
Yeah, interesting question. There's a couple assumptions here that I'm going to make in that question. So unpriced meaning no cap is what I think you mean. In fact, actually, Greg, if you want to clarify that, that'd be helpful. So when you think about safes or notes or whatever, there's a lot of options that you have as a founder to raise. The most typical is setting a valuation cap. So Teresa comes to me and says, like, I'm raising my business, my fintech company at like a $10 million post-money valuation. You know, it's not necessarily at that point equity that I'm buying. It's more like an IOU. When she does a price round later for higher valuation. But like, you're essentially saying, like, if I put in $1 million right now at a $10 million valuation as a safe, I'm essentially buying like virtually 10% of the company, right? And uncapped notes kind of work a little bit differently. So the way that they work is, or uncapped safes, it's I put in money, and then my equity will then convert at the valuation of the first price round. So let's say that I give $1 million to Teresa right now. It's uncapped, and then she goes out and raises a Series A later on, just make the math simple, for $100 million, right? It's a priced round, right? Then my equity will convert to be 1 million divided by 100 million, which is basically 1% ownership in the business. VCs hate this because there's actually zero visibility about what they are buying in terms of the amount of equity that they should be buying. So a lot of VCs, and in terms of how they're judged by their investors, is how much ownership you can buy at what price. So the lower the valuation, the better. The more equity you can get for less money, the better, right? And very few VCs are going to be willing to invest in an uncapped note. Those who do participate tend to be angels. So when I was an angel, I did one uncapped note. It actually ended up being outstanding, right? But like when it's your own money and you're telling me like, yeah, like, you know, if you double my money in 10 years or something, I'm okay with that. Like as a lot of angels will take that. I think it's all right. If a VC were to say like, you're going to double my money in 10 years, that's the same thing as rounding down to zero. I mean, like they really need to have like a 50x or 100x outcome on a given deal in order to return the fund. So uncapped note is just like puts extreme risk on the fact that you're not going to hit your multiple in valuation at the end of your 10-year period. So I wouldn't do it. I generally think it's kind of a bad practice. And in this market, I think very few investors are going to be excited about uncapped notes and safes.
Thank you. This is from, I think it's Ramon. What do you think about taking an SBA disaster relief loan to ride out the bad times ahead? Low rates plus payroll forgiveness for some period of time.
Yeah, very pertinent question. I haven't actually looked at the terms of the SBA loans, but I understand that they're pretty good, right? Like it's I think it was like a 10-year payback and like really decent interest rate. So if you qualify for it and the terms look good, hell yeah, you should take it. I mean, like this is a scary time ahead. And if like the government or SBA can actually move fast to give you capital that's non-dilutive, and you have pretty high, and you're generally long in the economy too. Like to me, it's sort of like what I understand from SBA loans right now from this current like coronavirus bill stimulus is that's pretty long. Like the terms for payback are like 10 years or at least more than 5 years. So I'm pretty long actually on the United States still, even despite a lot of things. So like, do I think that this is going to be a recession? Heck yeah. Could it spiral into depression, which is 6 quarters of negative growth? I think it's possible. Do I think that like the United States will recover in 5-10 years from now? I'm almost 100% certain of that. I have no data. I'm not an economist, but like my gut says that. So like, if you can get some capital to ride out these times, and you think that you can get back to, I think, a growth period at some point, then it seems highly sensible. In fact, like I was talking to my partners just this morning of like, could we qualify for one of these loans too? I mean, like you know, we would love to actually do some like growth initiatives as well, and like hire more people if you know we have the ability to do so. So even we're looking at it.
Love it. So you hit on this question already, but I think it's okay to clarify. So Demetrius asked, what types of businesses would you say are a good look right now? FinTech, EdTech?
Yeah, great question. So for us, at least at Hustle Fund, we focus on software businesses. I'd say we index a little bit more towards enterprise software. So B2B, we really like. I'm still very long on just like software generally, only because there are such great margins in the software business, right? Like you can see like 93% profit sometimes on the software because it's very easy to deploy. It scales very quickly, adding users, like adds real money and very low overhead in terms of maintaining the software and so forth. So, and it also gives you, because it's so profitable, so many levers for customer acquisition. Like you can overspend on certain channels because it's okay. It's just going to eat into a very healthy profit that you already have. So software, I think, is still great. If I were to I'm really crappy at predicting stuff, But I'll say this, like, I want to go back to the topic of anti-fragility, which are like these sectors where shocks in the economy actually produce like surprisingly excellent outcomes for certain classes of businesses, right? So if you're like a really frugal operator operating really well and are operating in like certain sectors like remote work, for example, you know, things that kind of support the remote work lifestyle, uh, perhaps something in like logistics and delivery, although I wouldn't want to be in the business of like, you know, being an agency for careers right now. Like that's also laden with other kinds of risks. There's got to be like, you know, you can sort of see like what tools you're using a lot in terms of like the remote work or like post-corona world. And I think that it's very hot right now because it's so pertinent and acutely felt. So I would sort of look at those in terms of, for me, like just longer, not just sort of answer this question, just like more broadly, like sectors that get me excited are around women's health for one. And then, so I'll sort of talk about that. Like this is going to be, I guess, something that you don't hear a lot of VCs talk about, but like what's really fascinating to me culturally about women's health is that it was viewed as like an icky topic for actually most of the history of women, right? So like, let's talk about things that make it awkward, like fertility used to be a really awkward topic, menstrual blood, awkward topic, right? But like, let's talk about menstrual blood for a second. 50% of the world is producing blood that could be tested with all sorts of disease markers and data, right? We should harness that, right? It's like it's a blessing, right? Like you literally have like a sample of blood that like produces markers that can do amazing things with personalized health in the future, right? So that's like one example of like, you know, an arbitrage where like, because frankly I work with 93% men in my industry who are a little bit squeamish and insecure. You know, I think it's hard for them to actually wrap their minds around these kinds of women's health topics, which are so pertinent. And it turns out that 50% of the world is women, right? The other thing too that really gets me excited is fashion and beauty. So I'm not a great example of fashion and beauty, neither fashion nor beauty, but I do think that like once Corona's done, like especially, but like this notion of like personalization is something that that is really taking hold, and that the old norm of like producing fashion like 12 months ago in order for you to hit like the Gap store shelves 12 months later at a mall, like that's just really breaking down, right? So the rise of like influencers in terms of like you know, how they're directing buying behavior, self-expression via fashion, and then also just like the economic and sustainability costs of like fast fashion like really fascinate me. So like how we're getting clothes and how it's being personalized and how it's being done sustainably, I think is really a big space. And this is also one of those industries that has been considered like a women's thing, right? Just like, oh, it's just like women, and like, again, amazing opportunity for arbitrage here, because like if 93% of the men in this industry are kind of just like dismissive of this being a women's thing, and it turns out that like some of the big fashion conglomerates like LVMH and Kering Group are sitting on like hundreds of millions of dollars, if not billions of dollars on balance sheet for acquisitions, like, hell yeah. Like, I mean, like there's like a lot of liquidity for fashion and beauty founders to make. There's actually like, even the niches are fascinating. So like at one point I read this article about Black female hair products in the United States, and that alone is just $10 billion a year, right? That sounds niche, is enormous business, right? So focusing even on that sector, which is hyper directed, right, is going to produce some crazy returns. So I guess yeah, I mean, like these kinds of, I always have fun like brainstorming with founders and anyone else I can talk to about arbitrages, because there's so many out there. And then just remember the composition of the VCs: 93% men, mostly white and Asian, very concentrated kind of profile. All of them have good educations and privilege, right? That's going to be a blinding profile to a lot of opportunity out there. So if you're chasing some of those that are a little bit contrarian to this profile, I think you can unlock a lot of money. I think there's a Warren Buffett rule that I really like, which is to make a lot of money in business, you have to be both contrarian and right. And there's a lot of contrarian and rightness out there.
So I have a great question. It's anonymous. Curious if there are general terms that you specify for the first 25,000 you invest in startups, ownership, etc., prior to the full due diligence and larger checks.
Yeah, that's a great question. Gotta take a sip of LaCroix there. So before I answer it, we do a standard YC safe. So we'll talk about we'll negotiate the valuation cap. Generally, we try to come in pretty low for that first $25,000 check, not just because we're trying to game it, but also because usually the founders are very, very early, and in many cases we're even beating their moms and dads and family members or other angels for that first check, and that's a real privilege and very exciting. So standard YC terms, the two big terms that we also ask in a side letter is pro rata rights, which outlines that we have the ability to invest in future rounds, and we want to outline that and protect that right if it works out. And then in addition to that, I think is information rights is the other big term, as I think back to our side letter. So information rights is sort of an interesting one. It's you should feel comfortable opening up your books, opening up your software data to us. And the reason why that's important is, as we're collaborating, we want to be able to rely on the same sources that you're relying on to measure the success of your work. So it's easier when we have access directly to that software, or at least to some version of that data. And no one really pushes back on either of those terms, because what we also promise back, I guess, in terms of the social contract is a very, very directed period of growth help during the period of time right after that 25K check. And you can think of it almost like a mini accelerator personalized just for you, right? So we feel very strongly about the value that we can drive. All of us have started, scaled, and sold a company as general partners. You'd work with one GP. And then in addition to that, too, just we've had a core focus on sales and growth primarily in most of our careers. So that's the terms.
Question from Dwayne. Not sure if you can answer this one, but we'll try it. What are your thoughts on the commercial real estate market? Is retail something investors are investing in now?
Not really a real estate expert myself, but it sounds like it's really tough, right? I mean, right now it's almost impossible, right? Because you're sheltering in your place, and I'm not sure if speculating on commercial real estate is something that a lot of people can do right now. The recession, I think, is also a big part of it. So I tend to find that, well, I guess real estate is really a contradiction in some ways. In recessions, I kind of always wish that I owned a lot of property, because those rent checks would be really nice and consistent right now versus as I guess a counterbalance to whatever stocks I have left. But on the other hand too, if you don't have capital to buy buildings by selling off equities or other assets you have, it's tricky. So rather than just blathering about stuff I don't know, I think I should just stop there. Really good real estate funds out there. I think Fifth Wall is one of the most exciting new funds in this space. And there's definitely a pretty healthy sector, real estate specific venture capitalists. One thing I will say, which is usually when I see real estate plays, there's usually some sort of debt underwriting piece to it, right? Maybe you're trying to get financing to renovate an entire building, and that's usually discrete from venture capital. So a lot of real estate deals that I've seen normally cite the strategy for how they're gonna get some debt to underwrite some of the operations of commercial real estate. That's something I'll just call out. I don't know much about it, but my understanding is that class of investor is quite different from what I see most VCs operating as.
All right, and I'm going to go with this last question from Raul. He says, do you work with solo founders? Have you helped a solo founder recruit a technical co-founder? And you already you answered the last part, so.
Yeah, we work with solo founders. In fact, I was a solo founder myself for 9 years. And I'll just sort of have a quick aside on that, which is just like, it's a lonely, lonely journey. I mean, like I'm so lucky that I have two other partners, Elizabeth and Sheehan, at Hustle Funds. And, you know, being a founder is already so lonely. Being a solo founder is like existentially lonely. I mean, you go to such dark places, everything relies on you. You have to figure out things yourself. I have my down days, a lot of down days too, but you know, my partners will lift me up. So, and vice versa too. And, you know, there's also days where like next week, for example, I'm taking a little bit more time to homeschool my kids as I trade off with my wife a little bit. And so, you know, my partners cover for me. Right. So, you know, being a solo founder is nothing wrong with it. And we'll definitely work with solo founders, and we have. But I also do encourage you to find some partners if you can, at least like later. In terms of helping you to recruit for technical teams, generally we don't. Only in the cases where the company will graduate into becoming a core position, you know, one that receives a larger check from us, where we've invested quite a bit of money, where we start to get really close to the teams in their recruiting strategy. Right now, like I'm helping a number of companies to find their VP of products, VP of sales, some of those high level conversations. And I would expect that your VCs would do the same for you. But if you're a solo founder and we're only at the 25K check level, it's not scalable for us to focus on helping you recruit at the end. So it's not a project that we'll pursue with you.
And Eric, thank you. That's it. For all of those who are asking if this is being recorded, it is. We are going to send this out to you tomorrow, so you'll be able to watch it anytime you want, as many times as you want. So just make sure you look out for an email from us with a link to this, or you can just go straight to our YouTube page for early growth. Eric, can we please give him some love? Thank you so much for being so transparent, for being so generous with so much information to help us really figure out what our next steps are, how to deal with COVID-19, and what we should look out for. So thank you. Everyone is saying thank you.
Thank you, Teresa. I just a massive, massive shout out back to you though for doing an exceptional job in just organizing this whole thing. You're a wonderful host. You guys didn't see any of the prep that we had done before. She had done so much work to make sure that this was a well-executed webinar. So please give Teresa lots of credit. I hope that you guys can follow more of her sessions, and very much appreciate that you're doing this important community work during this time. It's really, really cool to see you guys doing this. So thank you for the opportunity.
Thank you, thank you. And let me see if I can just reshare with you guys. I want to make sure. No, I can't. That happens every time. Okay, so I just want to make sure that you guys know about our tax promotion. If you haven't filed your taxes yet, we are having that promotion through April the 1st. You'll just go to earlygrowth.com/tax promo. You can take $500 off your tax preparation. Always get an expert, guys. Don't try to do it yourself. I've learned that. Thank you again, Eric, and everyone have a great Wednesday, and we will see you for the next one. I think next week. Yeah. Bye, Eric.
Bye. Thank you.